Okay. Hello, everyone. We're going to give it a couple of minutes. The webinar has just started. We'll give folks some time to log in, get into the presentation before we go. So we'll just give it another minute before we sort of say our formal hellos. Okay. I'm going to kick things off. Hello, everyone. Tim Holland. I'm the Chief Investment Officer here at Orion OCIO. On behalf of the entire team, we hope you're all well and healthy. We appreciate the trust and confidence you have shown and continue to show in us, and we appreciate you taking the time to join us for this quarterly market call. Clearly we're living in a pretty difficult and a pretty frightening time. The horrific attacks by Hamas in Israel have led to really the biggest military activity or action in that part of the world in some 50 years, really since the Yom Kippur War in 1973. But at the risk of being hard-hearted, we are going to speak to those geopolitical events and how they might impact our economy and the markets. And we remain cautiously optimistic on risk assets as we move into year end, even if there are signs that the economy could weaken or soften into 2024. We have a lot of great content to get through today over the next 50 minutes or so. We want to try and set aside some time for Q&A. So if you have questions, please enter them into that chat box, and we'll do our best to speak to them and get to them on the webinar itself. If not, we'll circle back after the fact. And with all that said, it's great to be on with Kurt and Monica and Josh and Ryan. And so we're gonna kick things off by I guess me saying hello to my friend Kurt and letting Kurt say a couple words. So to all of you, Kurt, take it away.
Oh, it's great to be here. This is fun. I miss everybody. I'm joining from the Northwest. I'm up outside of Seattle. It's a cold, rainy day, of course, here. So I got my hot cocoa, ready to talk markets. Tim, thanks for taking us through this, bud. And thanks for letting me be a part of it.
No, it's great to see you. Glad you and your family are doing so well. We really are. So Ryan Dressel's going to drive the bus on the slides. We're all going to go off camera at this point in the presentation. We'll come back on at the end, but we just figured it's easier to keep the focus on the content. So with that said, okay, Ryan, if you could click to the next slide.
Let's do it.
Okay, thank you. Can you go one more?
Yeah, should be up there.
All right, I'm still on the cover slide.
Uh-oh.
Shoot.
Let's try that again.
Miracle of modern technology. We appreciate everyone's patience.
How about now?
Nope, still looking at Q4 Market Outlook webinar. So what we are going to talk about today are geopolitics, the events in the Middle East. We're going to talk about a rough couple of months. August and September were pretty difficult for risk assets. October's been a little volatile too, but knock on wood, we had a good day today. Ryan's going to take the lead on digging into the bull market, which is still ongoing. Josh is going to talk about our outlook for the economy. Monica, including portfolio positioning. Monica is going to dig into opportunities within fixed income, and I'll talk a little bit about the election, which is only 12 months away, give or take, and we'll spend some time on what we like and what we don't like, which is how we've always closed these presentations. So I can see geopolitics up there. So if we can go one more slide. All right, that's great. And I'm going to ask my friend.
Stick with that, Tim.
That's perfect. Thank you. And I'm going to ask my friend Kurt to weigh in on the first couple sections, because he's obviously been in this business for a long time, and he and I have always had a really good just good time talking about these sort of macro events, even when they're very frightening and unpleasant. We just pull up a slide that looks at sort of the timeline of sort of the geopolitical dynamic in that part of the world from the smart folks at Stratford. And the reason we pull it up is because we're not experts on this part of the world, and we're not going to pretend that we have a solution to this ongoing conflict. But we pull it up to remind ourselves that this is long-lived. It's very complicated. The attacks by Hamas were horrific. And our best guess is that Israel will regain control of its borders, and we will get back to some point in time sooner than later. That's a kind of a status quo situation, which I guess is untenable, but it's probably the most likely outcome if that makes sense. And if we go to the next couple slides, or go to the next slide if you could, Ryan. Just make a couple points about the macro backdrop. Again, not to be hard-hearted, and obviously Kurt and everyone else can weigh in too. A lot of people think Middle East, they think oil, they think price shocks, they think the 1970s. Our energy profile is radically different today than it was 50 years ago. We're a net exporter of oil. 50 years ago, we were a net importer. Again, not to be hard-hearted about it. It's just our way of saying that as awful as these events are, we don't think they're going to have much of an impact on the energy market, and the energy market is the most likely transmission mechanism for inflation, for this awful set of events on the ground to impact our economy in a meaningful way. So there's that. And the next two slides, I'll just speak to the next one, and Kurt can talk about sort of the macro and the history of geopolitical events on the market. Iran is the wild card, for lack of a better term, and what it's doing by proxy over there with Hamas and Hezbollah. But Iran's also a marginal producer when it comes to global oil markets because of sanctions and some other curtailment on their production. So again, not to be too analytical or too cold-hearted about it, we just don't see this having a big impact on the oil market, which means it shouldn't have a big impact on inflation and our economy, at least if things go the way we think they're going to go. And that is towards some sort of détente and stalemate. But Kurt, maybe because you've been in this business for a long time, a little bit of perspective on when these awful events flare up and how investors should think about them.
I think there's a couple of important points. Obviously, the humanitarian aspects are the issue, right? I mean, but that's not why we're here. That's not what we're talking about. The reality is, historically, every time something happens in this part of the world, we all worry about the exact same thing, right? And that's why a lot of times markets have a knee-jerk reaction to this, because it feels like it's the start of World War III, right? It always feels like, this is the tinderbox is gonna be right here in this part of the world. For the history of the world, everybody's been talking about this, right? This is where it's going to go down. The reality is our fear is always worse than the reality of how this spills over into global economics. It just always is. And at this point, Tim, to your point, less than 3% of the world's oil production is coming out of Iran. And there's a lot of players in that region that would love to have Iran pounded. Iran doesn't have a lot of friends. I don't think it's going to hurt anybody's feelings. We all get nervous because we worry about, how many different countries are going to get drawn into this, but this is not a World War III kind of thing. The other thing that's important is this slide that everybody's looking at here. And I love, there's many iterations of this same slide out there, but the truth of the matter is when you talk about geopolitical events, they almost never have a dramatic impact on financial markets. I mean, look at some of these here. Pearl Harbor, 1 year later, the stock market was flat. Cuban Missile Crisis, up 27% in a year, right? I mean, and why is that? It's because a lot of the scary things are really ultimately don't impact global economics very much. And we view this very much, Tim, in that vein. It's a horrible thing to watch, and it has a lot of ramifications, but probably not on your portfolio.
Yep. No, that's a great way to think about it, and great perspective. We have these awful events in the Middle East following on a couple of tough months, August and September. And again, we're here to talk about the markets and the economy and how we're positioning your portfolios and how we're allocating capital. So August and September were both pretty unpleasant months. If you look at the bottom of the chart up on the screen right now, September is off 4.2%. Not to make light of a 4.2% pullback, but 9 of the 13 worst Septembers out of the 15 listed on the graph were a heck of a lot worse. And what's most important is if you look to the right, a tough August and a tough September tends to be followed by an up October and a pretty darn good fourth quarter. So if history is any guide, we've got a better days ahead as we move into year end. we like to remind ourselves as long-term investors, nothing goes straight up, including markets. Pullbacks are part and parcel of investing. We had a tough August, we had a tough September, we had some really unpleasant down days, and we'll talk about what we think weighed on stocks. So obviously we're running diversified portfolios, but it's kind of interesting as we sit here in October, the S&P is still up meaningfully year over year. It's still up about 11% year to date, and it's only off about 8% from its all-time, or sorry, its 52-week high back in July. So again, tough couple months, but perspective is important. The price of oil had bounced through the summer, and bonds sold off. And I know Monica in particular is going to dig into what's been a tough stretch for fixed income so far. And really, as bond yields move higher, while that creates opportunity in fixed income investments near term, it makes bonds a little more attractive relative to stocks. It makes future earnings for companies worth a little bit less, and it tends to be a pretty big headwind for equities. Again, as we sit here on our call today, the yield on the 10-year has backed off a little bit. So we'll see if maybe some of that move isn't going to continue to reverse itself. Seasonality, if you look on the slide right now, on the screen right now, September is by far the worst month for the S&P 500 on average, going back over 70 years. And in our letters of the last couple of months, we talked about expecting some volatility in August and September. We got more than we would like, but again, it's part and parcel of investing. And at least for now, the calendar has kind of rung true. The good news is October, November, December, and January, as you also see on the screen, tend to be nicely positive. So again, if history's any guide, we're moving into a much more, and we are in a more favorable period. I already made this comment earlier. The S&P is up about 11. Bonds, at least the aggregate, the Bloomberg aggregate, has sold off. And again, Josh and Monica will get into that. But stocks are still up year to date and still up nicely year on year, despite some of the geopolitical headwinds and the backing up in bond yields. And finally, before we talk about the ongoing bull market, and it may not feel like an ongoing bull market given the tough 8 or 9 weeks of late, we want to call out, if you can make out the graph or chart on this slide, because I know it's pretty small. Diversification helps during difficult times, and we build thoughtfully constructed diversified portfolios for our clients, leaning a little more towards risk or not, depending on the end client. And what you remember is that, in any given year, typically at least a couple, if not more than a couple, asset classes tend to be biased up and to the right. And at least as we sit here in mid-October, U.S. stocks continue to lead the way, growth stocks in particular. And we've got a bias to U.S. equities and quality U.S. equities for sure, which Josh will get into during his comments as we build the portfolios we've been building for our clients. So again, a bumpy 8-10 weeks, lots of reasons as to why, but we're moving into a much more favorable part of the year. So let me hand it over to Ryan. He's going to spend a couple of minutes talking about the ongoing bull market, which is still, knock on wood, in place. And again, we're still pretty optimistic on stocks into the new year. Ryan, why don't you take it from here?
Yeah, sure. Thanks, Tim. I think many people will be very surprised to hear that we're 20% off of our 2022 low, which was about a year ago today. We officially started a new bull market back in June. And a lot of the catalysts that we think drove that recovery are still true today for our optimism as to why we're optimistic on risk assets going into 2024. Some of those things include falling inflation, an improved monetary policy outlook. So we think the Fed is close to being done its interest rate hike cycle, better than expected earnings, overly bearish sentiment, and then also reasonable valuations. So those catalysts are really drove the recovery back 12 months or so ago, and they're still really present today, despite the pain that we felt in August and September. So I'm just going to get into a little bit of the data behind that to support that view. And if you look on this chart on slide 18, we can see that investors and portfolio managers were really caught off sides. So investor sentiment was really low a year ago. Everyone thought that inflation was just going to run indefinitely higher. We were looking at 9% CPI back then. The Fed was raising rates like crazy, and everyone just thought, things were just going to get worse and worse and worse. Turns out that you can only get so much worse before you start to get a little bit better data, and that started to come. We reined in inflation a little bit. The Fed got a little bit more comfortable, and they've started to back off in their rhetoric about rate hikes. Valuation was another key component to that, and stocks became cheap. Eventually, Wall Street said, "Okay, I'm willing to take a little bit of risk here. Despite all the volatility and despite all the headwinds that we see, I'm willing to put some money to work at current valuations." So they've ran up a little bit since 2022, but they're still very attractive compared to history. And that bear market that I spoke to was really a really long one. I think it lasted 248 trading days, which was the longest since 1948. And that can weigh on sentiment a lot and give people a negative outlook when things might not look as bad as they seem. So in that bear market, the S&P declined about 25% at its worst point. The good news is that when you get through it, like we have, on the other side of that, returns 3, 6, 12 months out and beyond start to look pretty attractive. And if you look at that grid there, you can see the percent of positive months turn out to be in the closer to 70% for stocks returning a positive return. And then 12 months out, more than 9% return, which is pretty compelling to history to lean on. On the bull market side of things, the average bull market tends to last 4 to 5 years. And if you look all the way on the right on that chart here, what we're showing is a full market cycle of each peak and trough for the S&P 500, dating back to 1957 or so. And that I circled that red area to highlight how early we are in the new bull market. So if you think that bull markets last 4 to 5 years on average, which we think they do, you're still in the very, very, very early innings of what could be a long-term market move higher. So I mentioned inflation coming down over the summer months, and the Fed getting a little bit more comfortable with prices being reined in. As you can see, was a dramatic change in both the consumer end side of things and the producer side of things, but much better today versus 12 months ago. And the key indicators for what the Fed prefers to look at, which are core measures, that includes things like wage gains, shelter costs, healthcare, et cetera. That's really been slow to correct at first, but really encouraging as we approach 2024.
Yeah, and then Ryan, if I could add quickly on the inflation front, and this is something Josh called out in our last market call. Shelter inflation has been a real sticking point, but there are signs that has begun to roll over. And even though oil prices spiked through the summer, even before, again, the awful attacks on Israel, gasoline futures are pricing in lower prices at the pump, which should be good for sentiment and spending into year end. And again, should both data points should help pull inflation lower further still as we move into year end. So those two are kind of in the pipeline in a good way.
Great point, Tim. And as I mentioned, the Fed being close to being done their interest rate hike cycle, it's been a long 15, 16 months since they started hiking rates. The market thinks that they are done. So they are betting that the Fed has done the rate hike, even if they left the door open. So what this shows is the futures market for the target Fed funds rate. That is the rate that the central bank adjusts at their FOMC meetings. And as you can see, the current level of 5.25% is what markets are betting on that the rate being all the way out into June of 2024. So they think things are going to go sideways for a while and then eventually come down. How long that takes to play out is anyone's guess, but that's kind of where markets see things going into 2024, which would certainly be encouraging for risk assets. Earnings have also helped. So they've been incredibly resilient. Corporate America continues to churn out profits among all these challenging economic headwinds. And we actually hit what we think to be the bottom in 2Q 2023. And analysts are pretty optimistic in the third quarter, fourth quarter, and into 2024 as well. And we're really in the peak of earnings season this week. So look for a lot of headlines to come out in terms of how corporate America is doing profit-wise this week. I mentioned large institutions being caught offside. So a lot of portfolio managers held cash when they shouldn't have been. You can see on that chart, what it shows is the amount of cash and defensive assets held by managers, being really, 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 really low into 2023. and they should have been holding stocks when things look really bad. I mentioned the bear market producing good results coming out of a bear market, but also results are encouraging at the end of a rate hike cycle. So 6 and 12 months out from the last Fed rate hike, returns are very encouraging there, about 11% on average 6 months later, and then a full year later, also 12% higher on average. And then we talked about seasonality with Kurt and Tim on the downside of things. The opposite end of that is just what Tim and Kurt mentioned, being really encouraging months for October, November, and December as we head into 2024.
Yeah.
So just real quick, I thought I'd just recap things. We're really encouraged by inflation coming down. We're really encouraged by the Fed almost being done the rate hike cycle. Earnings have been resilient. Sentiment's been way too bearish. And then valuations are pretty reasonable. So that's kind of the pillar for our optimism on markets as we approach 2024. But Josh, I think the economic situation or the economic picture might be a little bit more challenging to interpret.
Thanks, Tim. Did you want to jump in there?
Yeah, no, I was just going to say Wall Street hasn't come up with something as catchy as sell in May and go away for I came up with something along the lines of, remember to buy back in November, but that's not as I thought it was clever, but it's clearly not clever. But no, I'll take the calendar flipping in our favor. But yeah, let me, Josh, why don't you take it away in terms of positioning and sort of, as we like to put it, sort of investing through the cycle and building portfolios that can do well, even if maybe the world gets a little more challenging in the new year.
Yeah, for sure. And Tim, I think you've said it really well, and you've taught the team and people, previously that the markets and the economy, while obviously there's linkages between the two, they're not the same thing. And so you can still experience pretty strong, attractive returns in equities, even in a period of time where maybe the economy is not doing as well. And so I think that's something to remember. And Ryan, I really like that chart that you showed around the bear markets and the bull markets. It reminds me, I was at a conference recently and there was a trader there, and he was a brand new trader in 1987 when you had that massive one-day sell-off and people were crying, and it was just a very terrible experience for anybody in the markets. And he turns to this old kind of grizzled trader that was next to him, and this other trader, and so he's brand new, so he's obviously scared, but this old kind of grizzled trader just turns to him and says, fear is temporary, greed is permanent. And I think you have to remember that in times of when things are hard and the markets are selling off, it's just temporary. So let's jump into recession. So yeah, I mean, if let's rewind the clock to October, the same time last year, if anybody can remember, markets were selling off. Everybody on CNBC was talking about recession. All the big economists were out there talking about how there's 100% recession, and all of them were targeting kind of Q1, Q2 of 2023 for there to be a recession. And the reality is a recession never materialized. Yeah. So how did all these economists get it wrong? Why did a recession never materialize? And if you think about the market's actually pretty good at discounting the potential for future things to happen. So as the market was selling off in 2022, in expectation of this recession, even the market got it wrong. So let's go to the next slide and talk a little bit about why people got it so wrong. If you want to go to the next slide. Federal government spending has definitely been a tailwind for the economy. So the federal government continues to spend a significant amount of money and continues to run a deficit. And that on a net basis is good for the economy, at least in the short run. I think it's another argument, maybe in the long run, the potential impacts, but in the short run, it's good for the economy. If we want to go to the next slide. Unemployment and just the employment picture has been very strong. So unemployment rate has remained near record lows during all this time. Labor force participation rate has increased. That chart on the right, you can see that. So what you're having low unemployment. So a lot of people, it's relatively easy to get a job, and there's more people that are coming back to the economy, coming back to the labor force. And so that's also been a boon, I think, for the economy. If we want to go to the next slide.
Yeah, Josh, I think it's really important to point out, that unemployment rate being so low, it's just so hard to get a recession if everybody's, employed and bringing in and paychecks and not defaulting on their loans, not missing their rent checks or their mortgage payments, et cetera. So I think that this chart here on the unemployment rate is really important to point out as a factor as to why we haven't had that recession just yet.
Yeah, for sure. I think liquidity in the system. So that this chart on the left talking about, liquid assets at corporations, we don't have a chart on it, but obviously I think the average individual also had significant excess savings during COVID. And so they've been spending those savings down. So you had just a lot of liquidity in the system. And then if you look at that chart on the right-hand side, that's talking about just trying to measure kind of risk in high yield. And that's measured by this option adjusted spread. So how much you'll get compensated above the yield on treasuries. And so you can see during times of stress that spikes. We haven't really seen that spike too much. So that's just another indicator that potentially there's not as much stress in the economy and for corporations to refinance their debt right now. So you look at all those factors, strong consumer, you look at government continue to spend money, you look at unemployment, all these things are bleeding into a relatively healthy economy, all things being equal. And you're seeing that in some of the GDP numbers. So this chart on the left talking about, this is GDP Now's forecast. And the forecast right now for Q3, so the quarter that just ended, is an annualized north of 5% GDP growth. So pretty impressive numbers. So obviously the economy continues to hum along despite all the fears that we had a year ago. Additionally, I did want to point out on this right-hand chart that, and it's kind of shocking to me how well the housing market has held up despite interest rates, mortgage rates getting back up to kind of pre-great financial crisis levels. I mean, we're seeing mortgages with a 7%, 8% on the front, and it's kind of crazy. So it's definitely something that we're watching and we're thinking about. But the fact that the housing market has remained relatively robust as far as like home prices have not declined very much across the country and has actually started kind of bottom and started coming back up again, I think is a pretty good sign. And hopefully it won't be a headwind. We'll put it that way. Want to go to the next one?
Josh. Hey,
Yeah.
Josh, can I jump in here?
Yeah.
Real quick, two things. So on the chart on the right, the housing thing is interesting because the prices are holding in, but that's somewhat normal. We're seeing a complete collapse in the mortgage apps. So, you're going to get people breaking price, and we're seeing markets like Phoenix and stuff down 7 and 8% already. So I actually think it's a really constructive cooling, but the prices have a tendency to lag based on where the mortgage apps go. So we're in that period right now where people are still hoping they're going to get their price on their house. But I think we're going to see a little more slowing there. The prior point on this GDP at 5% thing, and I think this is important. I think the media doesn't want to talk about this, but this for the Fed is the perfect situation for them to normalize and right size the rate environment. Because 24 months ago, you tell us that we're going to be knocking on 8% mortgages. All of us on this call are going to say, oh, well, the economy will be cratering if we're looking at 8% mortgages, right? You're looking at a 5% GDP print. You're looking at employment that's rock solid after coming off 9+% inflation and the kind of rate ramp that we've seen. This is perfect for the Fed. So the Fed gets the excuse and the pass to go ahead and tighten as much as they need to and get it right now and make sure inflation is in the rearview mirror, because then they've got a lot of monetary tools going back forward. And so you're not going to see the Fed getting off of that, especially with the economy holding in the way that it is, right? I mean, and I think it's an important thing that we need to acknowledge.
Yeah, I think you're absolutely right. Yeah, and the housing market is crazy. I mean, both the supply and the demand have basically kind of fallen through the floor, and so it's created kind of a situation where nobody really wants to move either direction. Okay, so let's talk about just looking forward. I mean, the reality is the Fed does not, historically speaking, have a great track record with increasing interest rates and not causing a recession. It just is, it's just a fact. And so if we want to go to the next slide, let's talk through some of these things and some of the things that we're seeing. So one of the things that we like to look at, inverted yield curves, that's the chart on the left. So what we're looking at here is short-term treasuries and the yield that you get on those treasuries versus the yield that you get on a 10-year treasury. And then that difference is shown here on this chart. So historically speaking, and this has actually been a pretty accurate indicator or predictor of recessions for the last 50, 60 years, is if there is an inverted yield curve, that typically lends itself to then resulting in some type of recession, or the market's predicting a recession in the next 12 to 18 months. Like I said, we are in an inverted yield curve right now. We were last year. We haven't seen a recession. We're actually in one of the longest periods of an inverted yield curve so far. So that's an indicator that potentially there's a recession on the horizon. Real Fed funds rates, looking at that right chart, all things being equal, if real rates are positive, then that means overall kind of the economy is a little bit more constrictive, or the Fed's kind of constricting the economy, trying to slow the economy down. And that also could potentially kind of lead into this recession.
Hey, Josh, I think actually on the inverted yield curve subject, it's really important to point out something that's really misunderstood a lot of times about that indicator as a precursor to recession, is that it's not thing. It doesn't cause a recession, but it's an indicator generally of that the rest of the market thinks there's going to be a recession. But it does tend to be pretty accurate at predicting it, but it doesn't tell you when that's going to happen, how much of a lag there is, how long that recession is going to be, how deep it's going to be. It really can't tell you those things.
Yeah, and Monica, interestingly enough, before COVID happened, the yield curve inverted, and we still got the abrupt recession from COVID.
Exactly.
So some might say it has some magic powers.
Right.
Yeah, that kind of, I could jump in quickly. Sorry, that inversion was kind of interesting or frightening or spooky, for lack of a better term, because no one could see the pandemic coming. Monica, those are all great points. The best explanation I ever got around how to think about the yield curve, because you're right, it doesn't cause a recession. There's no, it just sort of inverts, to Josh's point, historically before we get a recession. And someone explained it to me this way, was just kind of think about it as it ties back to the banking system and the creation of credit. And if banks, sort of borrow short and lend long, but in terms of borrowing short, they have to pay me more for my checking deposit than they can loan out to a developer over 10 years. They're just not going to make that loan. So I always thought a great way to think about an inverted yield curve was, sort of interest rates are upside down. Think about what that would do to a bank and its ability to create credit. And for me, that's a good way to sort of think about it in a less academic fashion for what it's worth.
Fantastic. Yeah, I remember joking around with some of the analysts here that my kids are going to go to, econ classes in college and learn about the inverted yield curve and how it predicted, the economic crash that we saw in 2020, when in reality, there's no way it could have predicted that there was going to be, a major global pandemic. So the yield curve did its job again. But although I don't know how correlated that really was. Jumping into the Fed, and Kurt's absolutely right. I mean, we have such a strong economy, so the Fed definitely has kind of the firepower and has the willingness to move forward with increasing interest rates. So we've actually experienced that over the last 18 months. We've seen the most aggressive interest rate hike in the last 40 years. You see that on the left-hand side there, all the interest rate changes that the Fed have made. The most recent one being towards the end of July. The thing that's interesting about this is that when the Fed moves, it takes time for that to affect the economy. And we're going to have a quote on that in the next slide, but it takes typically anywhere from 12 to 18 months for those changes to impact the economy. And that impact on the economy, as this is a quote from Dr. Friedman, he's one of my favorite people to read. And he talks about how monetary policy, so basically what the Fed is doing has this effect on the economy that has a lag that's both long and variable. And as far as long goes, historically speaking, kind of 12 to 18 months for the impact on the economy to be seen. And the variable side of things is really what's difficult, because the Fed and everybody doesn't exactly know what could potentially happen. And there's definitely unintended consequences of the Fed actions that result in the economy. And I'll touch on that in a second, but I just want you to just remember those unintended consequences. So looking at the yield curve here, yield curve is inverted. We kind of talked about that previously. Looking at that chart on the right, major US leading indicators point to softening. And you can see that on that right-hand side there, that these leading indicators, is 10 major leading indicators put into a composite point towards economic softening. Going to the next slide. Looking at just purchasing manager index, you can tell that output is starting to slow down. Purchasers are decreasing, and then you can also see that just small business optimism has definitely come down, although it's coming back up a little bit, but it remains a little bit less optimistic than what we saw towards the end of 2020 and in 2021. Looking at, and we already touched on this, oil, so I don't want to belabor this, but all things being equal, when energy prices are higher, it's a little bit harder on the economy. I think all of us have felt that over the last couple of years as we've gone and filled up our gas tanks at the local gas station. It definitely has an impact on consumers, and it just means less money for consumers to be able to spend on other things. Lastly, and this is what I want to talk about with the unintended consequences, if you take a step back and think about what the Fed's trying to do, the Fed's trying to slow down the economy. So it's as if the Fed's a driver in a car, and the car's going a little bit too fast. And so the Fed's going to increase interest rates, which is the equivalent of kind of tapping on the brakes, trying to slow the economy down. And then there are these potential kind of unintended consequences. And I think we saw that in the first quarter of this year, where the Fed had increased interest rates very quickly. And then we saw a couple major banks fail. I would say that was most definitely an unintended consequence of our most recent rate hike. The Fed and regulators stepped in, they supported the banking system. We were able to kind of weather that relatively well. But going back to this, and I like this chart because it shows what's really happening at the banks, and back to what Tim was talking about how banks are thinking about lending money in this environment. You can see here that the banks have really tightened their lending standards, which means that they're less willing to go out and lend money to individuals, to businesses, and that has a direct impact on the economy. It just means that the economy, businesses can't borrow money in order to grow. Individuals can't borrow money as easily to buy homes or to purchase things and to consume, and all of that then feeds back into the economy. So all things being equal, if you look at banks and they're tightening their lending standards, that's going to have an indirect impact on the economy and the growth of the economy.
Yeah, Josh, real quick, one more quick point about this one. If you look at 08 and 09 and even 2020, it was really reactionary. And this time around, folks who make loans and at banks, et cetera, are being a little bit cautious. So, the idea of a soft landing happening versus a hard landing is a little bit better if caution is warranted and you believe that caution, versus being reactionary to things already, forcing your hand.
So if I can make a couple quick comments before Monica gets into the weeds around fixed income. So I think those were all great points, Josh. Just for folks on the webinar, in a day or two, we'll get our first look at Q3 GDP. So that's going to come out, I believe, on Thursday. That number gets revised, but Wall Street will get a sense of just how strong the economy has been, and by most indications, it's been pretty healthy still. Friday, I believe, we'll get the Fed's preferred inflation gauge, the personal consumption expenditures index, and the last day of October into the first day of November is the Fed's next meeting. And based on what the market's pricing in, what Ryan was talking about earlier, most folks, I think including us, don't think the Fed's going to do anything. They're going to wait and continue to see how all these interest rate increases and the shrinking of the balance sheet, what kind of impact that's having on the economy. Because again, a lot of this data is going to be backward looking. Josh talked about sort of driving the car, and the Fed's got a tricky job, because a lot of the data it relies on is backward looking, but obviously it's got to keep the car on the road and wants to slow inflation without putting the car into the proverbial ditch and driving the economy into the ditch. So it's going to be a busy 4 or 5 days from a data set perspective. But with that said, let's turn it over to Monica, who's going to dig into fixed income.
Okay, thanks, Tim. So yeah, as the headline says, it has been a challenging year for fixed income. That's probably putting it pretty mildly. If you look at the returns there for year to date, we're down about 2.5%. We're just kind of hoping if rates don't go anywhere the rest of the year, that income can come in and make up the difference, and maybe we end up about unchanged on the year. That would be probably a good outcome given what we've had so far this year. And if we go to the next slide, you can see why we're still kind of nursing the hangover from last year as well in fixed income. This is just the 10-year Treasury bond return, which is obviously a lot more volatility than the ag bond index or most of our bond strategies because it's so long, but it does illustrate the pain point here, if you will. Last year's down 17.8%. This year. Again, we may or may not eke out a positive return. If we don't, it would be the third year of a down return in that 10-year Treasury since 1928. So that's pretty painful. Looking at the reasons for why that's happened, obviously the Fed raising rates an unprecedented 525 basis points over about a year and a half is the reason for that. Some of it somewhat has been a little bit of credit concern, and I'll talk about that a little bit more later, but the tone of the Feds lately has been higher for longer. That's what they're talking about. You look at these dot plots and you might say, well, that doesn't read that way. Well, don't pay attention to the dot plots. You really have to pay attention to what the Fed is saying. And it's really right now higher for longer. The market isn't pricing in much of a chance of another increase in November, but still leaving out the possibility we get one more hike before year end. And then, again, looking for that recession that just hasn't come yet. If we go to the next slide, I wanted to, just touch a little bit more on the curve inversion. And Josh covered this pretty well, but just to make the point here that the curve inversion doesn't create the recession. Again, it just sort of usually comes before the recession. And I like to think of it more as the long end of the curve being lower because expectations for GDP are lower because the expectations for the recession are there. And so I think that's why it typically is a very good indicator. Now, how long the curve inverts though before a recession and what it does after that can also be wildly unpredictable. But, we've been in inversion since May of last year. We probably hit the bottom in terms of the inversion in April of this year, and looks like we're coming back off of that. But by the time the curve actually uninverts, we could actually be out of the recession at that point. So you can't really look at that as a precursor. So the investor focus, pivoting to the long end of the curve again, is just that. And for that expectation of GDP being lower in the future is what creates that inverted curve, what is keeping the lower rates firmly anchored below the short rates. And as the yield curves moved upward over the last year, you can see the yellow line was last year, the bright green line up there at the top is this year. We've just sort of ratcheted up into an even more inverted curve than we had last year. But again, what happens from this point forward just becomes all about whether we get that recession or we don't get that recession. On the next slide, you see the cracks forming in the credit picture. This is showing you bankruptcy filings, and obviously we're starting to see a pretty concerning tick up in that. What we look for in the bond market, though, I think probably a little bit more importantly, we are also seeing that translate into default rates on bonds being somewhat elevated from where they were last year, probably on the order of about 70, 80 basis points higher, but they're still probably in range of where they've been over a longer term period, and nothing highly concerning. Most of the defaults have really been on that C rated and highly speculative bond range. But I think one thing that I like to point out though here is, when I'm looking at the default rates, it's really informing my opinion of where the value is, where rates ought to be at, because that credit premium of the corporate bond above the treasury rate is what is compensating you for that default risk. And so right now, when we're looking at investment grade default rates versus the high yield default rates, there's about a 100 basis point difference that you really need to sort of have a break even to get you over the hump, if you will, of the extra expected losses on high yield bonds. So I look for if the spread is not at least 100 basis points on high yield bonds over the investment grade, then it's a no-go. It's, there's no value there. But I like to see a healthier cushion than that, maybe something along the lines of 150 to 200. Right now, it's really about 120. So it's not all that attractive. For me, the high yield bonds are not really compensating you all that much for that risk. The value that we're seeing right now is really in both the treasuries and the investment grade corporates. And, of course, most of you've been seeing the treasury yields everywhere from 3 months out to 10 years, right about 5%. The 10 years kind of been bumping up on 5. It's come down a little bit, but some very attractive, particularly shorter term treasury yields. That's really been getting a lot of attention. And for me, I think probably in the treasuries and in the investment grade corporates, that's really where the best value is right now. The investment grade corporates, I believe our latest summer yield sheet was about 660, I think. I think that's just a tremendously attractive value on a fairly shorter term investment grade corporate bond ladder. Munis, we are seeing some tax equivalent yields a little above 7 now. That is obviously for just the higher tax bracket taxpayers. And we're still kind of in the range where 28% tax bracket and above is where you have the good value in munis. Below that, it's not quite so attractive. So I'd probably put that, the value spectrum here of the cheapness or the, really attractive values being treasuries and investment grade corporate, the sort of middling or good values being in munis, and then the rich or the not great values being the high yield corporates. Now, all of this, though, I want to put just in, in a little context here before I turn it over, in that the way that our investors typically are looking at their bonds is not really the way that most of the, say, institutional investors are looking at it in terms of looking for that total return. When we looked at the first few slides where we showed, all the negative total returns in bonds, that's really mostly about the negative price movement that was created when interest rates went up. It's not an indication really of the yield or the return for a holding period that our investors would typically have, because they're going to be buy and hold investors. So a lot of times they tell our bond investors to, not necessarily that they're not going to look at total return. Obviously, they're going to look at it because it's going to be on a performance statement, but that's so much less important to them than just the yield they're going to get, the longer term holding period yield that they can expect, because what they're really buying the fixed income for is that income and the lower volatility. And the bonds still do give you lower volatility than equities. And right now the yield portion obviously is really, really attractive. So I think that, that value proposition, if you will, in fixed income is definitely there. So now I'll turn it over to Tim, and he's going to close us out with a few thoughts on looking ahead to next year's election.
All right, thanks, Monica. And those points around fixed income are super important, right? That's a point in time what the aggregate's doing year to date. But if you buy a high quality credit from an issuer who's money good, as they say in the fixed income world, you're going to get your coupon, you're going to get your principal back, and you're going to have some nice offsets to the equity market volatility over time too. So we've got a couple slides on the election. We've got one question in the Q&A, which we're going to get to as soon as I get through these couple of slides. If you have any other questions, please enter them now, and we'll do our best to get to them. This just the two graphs on the screen now. We're in year 3 of the presidential cycle. Typically, you get about 17%. We're up about 11%. So we're positive. It's the best year by far of the 4, no matter what party holds the White House, and knock on wood, we're in the seasonally strong period for the market now too. So if history is any guide, we should finish strong. And on the right-hand side, as history would also have it, we're always up 12 months on from the midterm elections going back to the early 40s, and that's certainly the case today. The next 3 slides really kind of tell the same story. So I'm going to go through them somewhat quickly. The first just looks at polling data between President Trump, former President Trump, and President Biden, and it's a coin toss. The next slide looks at the breakdown of the balance of power in the Congress, right? With the Democrats holding a narrow majority in the Senate, the Republicans a very narrow majority in the House. The Republicans still unable to coalesce around a speaker. I just saw that Representative Emmer withdrew from that contest, so the Republicans still need a speaker. We're working off the assumption they will work through that sooner than later, but not yet. And then the next slide just looks at average returns for the S&P 500 based on the political or power construct in DC. And what you see, if you look to the left, is that it may be cliche-ish, but gridlock is good, at least on Wall Street. Markets like divided government, we think that's because divided government tends to give the market fewer surprises, right? You don't have one party able to make big changes in policy quickly. So if you think about the last couple slides, narrow majorities in the Congress, and then tight polling in the presidential race, the most likely outcome we think of the election in 12 months' time is divided government. And even if it's going to be a bumpy year and a contentious year, we'll get through it. And if that is the most likely outcome, again, gridlock should be well received on Wall Street. So I'm going to throw it back to Kurt to talk about what we like and what we don't like. But Kurt, why don't we also take a quick look in the Q&A chat box before closing this out and see what folks want us to dig a bit deeper into.
Yeah, that sounds good, Tim. Did you just say divided government? Wow, what a concept. Who would have thought? One thing I'll add on that, we've got great data, and we didn't prepare it for this, but I'm sure we'll talk about it more as we move closer to the election, because that's all everybody will be talking about, is historically there's zero correlation between which party is in power or what tax rates are and returns of capital markets, which is like the craziest thing to me. I always thought that was just totally bizarre, but there's literally no correlation. So it matters to our life in a major way. But what's so interesting is historically, it hasn't really mattered much to a portfolio. So we're going to see a tremendous amount of hand wringing around the election, obviously, again, especially if it is Trump Biden. But it's probably not going to have a dramatic impact on people's portfolios in the long term at all. So so we've gone through a few of these. This is our checklist. This is our team's working checklist. Inflation is coming down. We love it, but the Fed can err on the side of being aggressive. They've got the room to do it. They've got the excuse to do it, and the economy's in good condition. We do think that they've got to be getting close at this point. We're starting to see some real movement. They don't want to overdo it. We're into a new bull market. More importantly than being in a new bull market, we had a bear market. And it was a long one. It was 250 days, which is the second longest bull market in 70 years. And it sort of cleared out some of the dead wood. And that's what's important about that cycle. Valuation's not bad, kind of at the long run average. So stocks are not super cheap, not super expensive. We've talked about the hikes. We've talked about the bear markets. We do have a lot of room for sentiment to improve. There's still a lot of negativity, although it's not as bad as it was. And there still is a pretty substantial amount of cash on the sidelines, although some of that has been burned down. The banking crisis, we talked about that. We think it's in the rearview mirror. If rates continue to go higher, all bets are probably off on that. But we think we're getting more to an equilibrium here. Debt ceiling, we've talked about that. Mild recession is probably priced in. Clearly, something more major is not priced in. I'll tell you what else is not priced in is more inflation. That is not priced in. So if we have another ramp of inflation, it's going to be a problem. It's going to spook markets for sure. Labor market's obviously been great. And the consumer still continues to be pretty good. Although I'm going to talk about that because there's a great question in the Q&A here in just one sec. What we never like geopolitics, right? We don't like anything that surprises us, but most likely what's happening in Israel and Iran is not going to impact your portfolio dramatically. I can't believe how tame oil's been. Every other time in our life, oil would be going absolutely nuts. The dynamics of that oil market have changed so much in our favor in the last 10 or 15 years. DC, it's a dumpster fire. We already know that. That's already basically priced in. Inflation, that's probably one of those outliers, right? That's why the Fed's got to hold where they're at. We've got to be sure this is done. Energy prices still tame. The bond yields, right? We've talked about that. If they get a big ramp, Monica touched on it. We're not seeing a lot of stress in the junk bond market yet. That's important. That's historically been a pretty good forward-leading indicator. So even though we've got some bankruptcies creeping up, which, by the way, we needed them. There's a lot of dead wood in the system after passing through zero interest rate environment, right? We talked about those zombie companies a lot in the past. We sort of needed a house cleaning, but we're not seeing stress in junk, which is really good still at this point, right? Especially with like 8% mortgages. I think we'd all be surprised that that's the case, like pleasantly surprised. We want to continue to see an expansion in what's leading out. And then liquidity coming in. We've seen a lot of reduction in M2, but we had a lot of liquidity to clean up. We increased our monetary supply by 25 to 30% coming out of COVID. So we really needed to clean a lot of that up. And that's what the interest rate ramp is doing, is taking care of that business. We had to put that genie back in the bottle. LEIs, we talked about that a lot. Okay, couple great questions in the chat. Let's talk about one here is, should we be increasing the exposures of bonds in the portfolio? Monica and Josh touched on this a little bit. There's clearly an opportunity here. So I know a lot of people on this call are sitting on inordinate amounts of cash still. There were, 2 years ago, why not sit on cash, right? You were not going to get paid to buy bonds. Okay, now we're in an environment where maybe you're at 2.5%, maybe 3% inflation, and you can get a tax adjusted 7% income, 6%, depending on what type of portfolio you build. It starts being more intriguing. So it doesn't mean that bonds necessarily need to be a massive outweight in your portfolio, but if you haven't done rebalancing in the last few years, you're going to want to talk to your advisor, especially if you're sitting on a lot of cash, because there can be a real opportunity here to buy some pretty high quality credits and get paid to hold them.
Kurt, I think
Yeah,
what
Monica.
also a great opportunity. I think there's probably a fair number of investors out there who maybe have been a bit over allocated to equities, given their age, nearing retirement, and so forth, just because they felt like they needed to catch up from previous losses, or they just hadn't saved enough, or they've been taking more risk than they really should have been. And now that the opportunities for income and fixed income are there, maybe they don't need to do that anymore. Maybe they can get back to what really is a more appropriate level of fixed income in their portfolio.
That's a great point. We've seen so much of that, haven't we, in the last 3-4 years? Tim, I'm going to throw you this question that's in the chat about the Speaker of the House, because that's your area. But let me touch on real quick. There's a great question about the difference in the consumers. And are we seeing more stress in the lower income group? A resounding yes, right? Car loan defaults, savings rates, burning down that. Housing affordability is just absolutely abysmal. And so, yes, to that point, it is a little bit of a tale of two different consumers right now. And so when we talk about the economy as a whole, we're losing the fact that in the lower income segments, there's a lot more pain. And we are seeing that group burn all of their savings. They are reaching a little bit for credit cards. They are having a little bit harder time. And that's one of the things. Of course, the Fed is watching that closely as well. And that's probably why, even if we get another quarter point hike, we're looking at a Fed right now that seems to be content with holding here until we get a little bit more data for exactly that point. Tim, you want to touch on this question here about the speaker?
Yeah, so I think the interim agreement that then Speaker McCarthy put in place, leaning heavily on the Democrats in the House, gets us to about mid-November. So we've got a couple of weeks to kind of sort through this. Historically, when we have had shutdowns in the past, even ones that have run for several months, while they're very disruptive for people on the federal payroll, they've had really little impact on the markets and the economy beyond sort of that headline shock. So again, call me terribly naive or terribly Pollyannish. I continue to think the Republicans will coalesce around a speaker. We've got a couple 4 weeks to get something done. I continue to think, though it hasn't really focused the minds as much as I would have thought, that the awful events in Israel would get people in DC to kind of come together and sort of deal with some of these issues that we need to deal with, especially around military funding for Israel. So historically, not much of an impact. I think we'll get something done, even if a short government shutdown is what's needed to kind of force people to kind of come to longer term solutions. We also had a question, or part of a question, around small caps. They've struggled mightily. We have had some decent exposure to small mid-cap companies. The valuation's so attractive, really cheaper than they've kind of ever been relative to big cap companies. Small cap companies tend to do better when the cost of capital or money is cheaper. So they get hurt by higher interest rates. But if we think, to Kurt's point, the Fed's done or just about done, and you're looking at lower borrowing costs in the back half of next year, that should prove pretty supportive, even if the macro backdrop or the economic backdrop isn't all that great. Because again, just from a valuation perspective, small cap stocks are super attractive. So I think that's it for Q&A. I'm gonna turn my camera back on at the risk of just upsetting everyone in the afternoon here. We want to thank everyone for taking the time to hop on the call. Hopefully you found the content of value. If there are other questions or comments you'd like us to get to, please reach out to us or your advisor. We'd be happy to circle back and connect on those questions or comments if any are outstanding. But it was great being with you all.
Hey, Tim, thanks for running us through this. This was fun being with everybody.
Yeah. All right, everyone, take care, and we'll talk to you in 3 months. Bye.